Hi, thank you for joining us here at Tax Talk UK, where we talk about all things tax and other important aspects of running your small business and working for yourself. So we've been asked if we can talk a little bit about stock control and how to account for this. Before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as finding other information that we have available on a whole host of topics that are designed to support you in your self-employment. If you want to be notified every time we upload new information, then you should also turn on the notifications. So on to stock control and accounting for stock. So let's talk first about stock control and what does that mean? Well, stock control is just a way of managing and recording the stock that you have. So depending obviously on what products that we're talking about may determine whether you're trying to manage only a small number of large items or a large number of small items. So it's important, of course, to always know what stock that you have available, to make sure that you order the stock so that by the time that you need that for a customer, that you have it in plenty of time. If appropriate, sometimes, of course, your line of work will mean that you just order stock as you need it. So here we're really talking about people that actually have stock that, perhaps that they're selling, for example. So it's important to have a record of the stock, to have an understanding of how long that stock will last, because on one hand, you don't want to have stock for years and years until you've actually sold it. But on the other hand, you don't want to keep selling out so quickly that your customers can't get the stock, can't purchase what they need to in a timely manner. So there's that aspect of why it's important. Also from an accounting perspective. So if you've got a high volume and a large amount of stock, then it is likely that you're going to have some software, perhaps a till software, that will help you to monitor the stock levels. But there still will be a certain element of sort of doing a stock count, for example, to check that your stock is the same as that your digital records are telling you. So when you're actually counting your stock, in terms of from an accounting perspective, we're going to want to know the stock at the point that you purchased it, how much you paid for it, not how much you expect to sell it for. So in the sort of context of what we're going to be talking about today, that's what we're going to be interested in. How much did you pay? All this stock that you have, whether it be on your shelves, in a warehouse, how much did you pay for all of that stock? What is the value of that stock? Now, another important consideration is, of course, for insurance, because if you have large volumes of stock, you will want to make sure that that stock is insured, and your insurer will want to know what is the average value of stock that you hold. So how do we account for this stock? Because, of course, you've purchased the stock. And so if that goes directly into the cost of sales in your account, then that is going to reduce your profit, but you haven't yet got the sale to match it. And of course, one of the fundamental things that we're always trying to achieve in an annual set of accounts is to know for that period, we're accounting for the sales and the cost of those sales. So if you haven't yet made the sale, then it's not a cost of the sale. And this is where we would make an adjustment in the accounts for the stock. And we do that by moving the value of the stock that you hold to the balance sheet. So we take it completely out of the profit and loss, and we move it into the balance sheet. So if you did that in the first year, you counted up your stock, you calculated how much you paid for it, remember, and we're looking for the cost to you of that stock, not the expected sale, and then you move that amount to the balance sheet by taking it out of the expenses, therefore having the correct profit and loss for that year. Then let's say in the next year you don't have any stock at the end of the year, then all of that stock would get moved back. Now it depends how you're managing your accounts, the complexity of your stock, and how consistent your stock levels are, would be as to how often you're going to actually make the adjustment in your account. So sometimes you may, at the start of the new period, you may reverse that adjustment, so therefore putting the stock back in, and you may every month you may adjust to make sure that you've got the correct value of the stock. If your stock was fairly consistent, you may feel that quarterly is sufficient, or perhaps if your business is very simple and the stock levels are fairly consistent, then you may feel that an annual basis is fine. So that is going to really be up to you to decide, depending on your specific business operations, how often you're actually going to adjust for the value of the stock, how often you're going to count the stock. And of course, the important thing to remember is the time that it takes you has got to be proportionate to what you're trying to achieve. So therefore, if you don't, for example, have some sort of till system that helps you to know the stock, and you're still counting your stock, and you have hundreds of very small value items, then it would of course be acceptable to estimate to some. But what I would suggest is that if counting your stock does take a lot of your time, and your stock levels aren't fairly consistent, then really you should be looking into ways to digital ways to be able to support you into having that information, because the more accurate information you have and the more often you have that information available, then the more accurate your accounts are. So for example, if your stock levels are fairly up and down, and through the year you may think, oh, this is great, I've made ever such a lot of profit, but then when you actually look at your stock levels at the end of the year, and then you adjust that can have a massive implication for your profit and loss, which has a knock-on effect then for your tax and liabilities, which hopefully throughout the year you will have been accounting for. So basically stock control is just thinking about how do you control the stock, how do you make sure that you have the stock available when you want it, but you don't have large amounts of stock, larger amounts of your cash tied up in stock. What do you need to sort of do with that? And then also thinking, how does that translate into the accounts, and how do you account for that by making the stock adjustment? So again, as I mentioned, it is going to be individual. There's not a you must do this or this is the best, because it will depend on the stock levels that you have. And of course, if you need any help with this, as I say, it can have a big impact on your profit levels and your tax liabilities. So if you do need help with this, then we would suggest that you engage a professional to help you with that, or perhaps an IT specialist if it's just the actual looking at ways to have digital support in monitoring your stock control. And of course, if you are engaging somebody's services to support you, whether it be from the accounting side or from the IT side, then please do check that they are qualified for the help that they are giving you, and that they have insurance and sufficient knowledge to be able to properly support you. So I hope that this helps. As I mentioned earlier, if you could take a moment to subscribe to our channel, Thank you very much for watching. Goodbye.